Hey everybody, Bill Faith here from Build Short-Term Rental Wealth, and I am joined by my good friend right here, Mr. Ryan Bakke from the STR Super Team. Ryan, how are you today, my friend?
Awesome. I'm doing well. Happy
Oh,
New Year, everybody.
I'm looking excited. I mean, come on. It's almost tax time. Don't you get jacked up for taxes?
Yeah, I do. I actually forgot my coffee. I gotta go grab it real quick. I'm ready. No, it's a new year. It's already the third day of the new year. Can you believe it? It's 2023 already.
It's crazy. So, welcome everybody that's jumping in. We're simulcasting this on 1, 2, 3, 4, 5, 6, 7 channels right now, from YouTube to LinkedIn to the Build STR Facebook group. If you guys have questions, just pop a comment down below. I'll be moderating for Ryan, and we have 30 minutes, so we've got literally 29 minutes and 6 seconds to answer all your questions. If this is your first time to Tax Tuesdays, Ryan and I are doing this every Tuesday at 2 p.m. Eastern, 1 p.m. Central. That's 11 a.m. Pacific. And if you do miss it, you can always jump into the Build Short-Term Rental Wealth Facebook group. It's recorded. You can use the search bar and just search for Tax Tuesdays and find the previous Tuesdays, the previous broadcast that we've done. But this is a live broadcast, even though Ryan just left me. I'm not the tax expert. The other thing that's super important, both Ryan and I put out a ton of valuable content on Instagram. These are our Instagram handles. Ryan's putting out excerpts every single day. I'm doing reels every single day. A lot of great stuff. So pop your comment down in your question down in the comments. And most importantly, say hello and let me and Ryan know where you're from, because we want to engage with you one-on-one. We don't want this to be like a webinar where we're just preaching. But I'm going to break the ice, Ryan. I've got a question. It's January 3rd. I'm sure people, didn't figure out exactly what they were going to owe in taxes in 2022, may not have known what their income was, didn't take advantage of, maybe missed a cost segregation, whatever it is. What can people do now post January 1st until filing if they missed opportunities in the previous year to get some tax advantages? We just talked about one that I'm actually doing right now. And I'm interested to get your take on that. Is there anything that we can do?
Yeah, so the important thing there is once December 31st hits, there's limited things that you can actually do to help your tax liability situation. Very few things. And that's why it's important to be planning throughout the year, during the year, as opposed to just waiting until the end of the year to start planning. One of the things that you mentioned is the SEP IRA. So this is going to be for people who have active trades or businesses. So maybe you're a real estate agent, or you're co-hosting, or you're flipping, or you just have a general business. A SEP IRA will allow you to contribute money to a retirement account and receive a tax deduction for that. The amount that you can contribute is actually based upon your business income. You have until the tax deadline. If you're an entity, it'd be March 15th, or if you're a personal 1040, it'd be April 15th. You have until the deadline in order to contribute to the account. And that's why it's important to get your documents in order early, because what you're able to contribute is based on how much money you make. So if you don't have your documents throughout the year and you know exactly how much money that you make every single month, you're going to be scrambling to figure out how much you can exactly contribute to this account.
So I think that's really important, Ryan, and you preach this all the time, is to have some type of consistent meetings, or at least an early understanding of your income and your tax burden. Don't wait until January, February, or March. So I'll just give myself a use case. I'm doing 4 cost segregations that for properties that were put into service in 2022. They're all significant. Basically about $4 million worth of assets. I've estimated, based on what you've talked about previously, right, the land value versus dwelling value, what percentage I should get roughly. I met with my local CPA here in Nashville in November, and we still saw that there was going to be about a $27,000 tax burden. So he's already gone through and he's basically ready to file, right? Just waiting on December's P&Ls and everything to come in. So that's when we started talking about, I don't have a SEP. And I'm like, dude, I wrote a $167,000 check after everything else, just a few months ago. I don't want to have another $100,000 or $200,000 tax burden. What are the options? And so I'm maxing out, and you probably know the number, whatever the max is, Ryan. I think it's $62,000 or $64,000 per person. So 160, let's just say 62 for me, 62 for my wife. That's 124,000. So that means I should have roughly about a 40,000 because I fall in the 37% tax bracket, probably around a $40,000 benefit to offset those additional taxes, and that goes into my SEP IRA. That's something I didn't know about. And
Mhm.
if I hadn't heard Ryan preaching about a solo 401k, it would have never even sparked that conversation with my CPA. Now, there is one drawback, right, Ryan? So if you run this through your business and if you have employees, then there is a contribution that you're required to make for your employees, right?
That's right. Yeah.
So that could be a drawback if you don't want to make a contribution. Believe me, Chris is loving it because now I have to make, I think it's like a 18 or 20% contribution, for him to go into it. So if I put the SEP under the entity that that employee works for. So if you have multiple entities like I do, you could choose one, that you would qualify for the income that has no employees, and then you don't have to do any type of match. Is there
Right.
anything
If you,
else, Ryan, that people can do between now and tax filing?
yeah, there's the SUP IRA is one of them. Unfortunately, for that solo 401k that I talk about, you actually have to have that set up before the end of the year in order to get the contribution for that. But the another thing that we do, at least what I talked about in the webinar that I had last night, is that you want to see your breakout between your income streams. So if you drew a T chart, right, on the left, you would have your business income, non-passive income, W-2 earnings, and on the right is going to be all your passive income from your portfolio. So maybe if you have long-term rentals, short-term rentals, multifamily, etc. And what you want to do is you should understand, and if you checked out all of my content, you know that right bracket can always be set to zero. As long as you have enough passive losses in order to offset your passive gains, whether it's gains from sales or income, you can always offset your gains, right? And this, it's a perfect time because the former President Trump's tax returns were just released a couple of days ago, and I haven't really had a time to review all of them. But that was a common theme that I saw in a lot of his returns, was that his passive income category bucket were all offset by each other. And that's why you talk a lot about architecting your income as far as what do you want to have for your time versus revenue or money earned. I talk about architecting your income as your income streams that you're earning, right? If I'm running a business, if I'm co-hosting, if I am a realtor, I have an active trader business, it means I pay the most in taxes on that. And it also means it's the hardest to offset. But if my income streams are coming from passive activities, primarily through rental real estate ownership, there are some other ones like laundromats and car washes, etc. But I want to be able to architect my income stream sources that are most tax favorable. So you talk about architecting your income in terms of time. I talk about it as what are you actually investing your money and time into?
Well, I think one thing that I wonder if a lot of people don't know, Ryan, that if you have multiple entities, like you do, like I do, those entities fall into different tax brackets as well, right?
Mm-hmm.
So I mean, it's not like there's just one tax bracket. If you have, I mean, I think I have 8 entities currently, and there's some in the 18% tax bracket. There's some in the 37% tax bracket. Do you look at that strategically when you're implementing these types of things?
Yeah. So anytime when you have a lower taxable situation year, you're going to want to look to potentially liquidate some of those assets that might be in a lower tax bracket because you're going to be able to cash in on them quicker. Adversely, if I have a high income year, I don't really want to be earning more money after I've hit the 37% tax bracket. Most people will say to that. So I'd much rather spend more time focused on putting assets into those lower tax brackets. And what we mean by that is there's 3 different types of income streams that you can make. There's earned income, which we're all probably familiar with like our day jobs and W-2s and such. There's a portfolio income, which is income from taxable brokerage accounts. So if you have interest or dividends or you have capital gains, that's going to be portfolio income. Those are taxed at more favorable rates than earned income. But like I've said before, the best income stream that you can have is that passive income stream because it's the easiest to offset, number one, but it also in the long run pays the least amount of taxes.
Awesome stuff. We have a question here. You do the SEP contribution after the year ends, but before you file your taxes, correct?
Yeah. So if let's say I calculated that I made $100,000 in business income, and I'm able to contribute 25% of my money, I would contribute the $25,000. Let's say on March 15th, and then I'd file my tax return on April 15th, as long as the contribution's made before you file the return.
Right. So I know that you have a couple of big modules coming up in the STR Super Team Accelerator that we're doing, right? And we strategically place these in this semester of the accelerator to where those are going to be dropped as people are preparing their taxes. Can you give the people watching here a couple of tips on what they need to do if they're not in our accelerator program to really start preparing their documentation? Because I feel like a lot of people, and I see it on social media, I'm sure you do too, and I used to be one of these guys to where, okay, here's the shoebox, boom, drop it on the CPA's table, on March 13th, or April 13th, to go in and do it. What should they start accruing now?
Yeah, definitely want, for each business, at a bare minimum, you want to have a profit and a loss, an income statement, right? So if you're dealing with rental real estate, we also call that like a net cash flow. Net cash flow is basically, you do not want to wait until right now to be doing your bookkeeping and your record keeping for the rest of the year. If let's just say on average it takes you an hour a month to do that for your 2 rental properties, if you wait until right now, not only is it going to take you an hour per month, but now you're going to go back and do everything for the months that you missed. It's probably going to take you twice as much time to get it up to date and accurate. So really the best planning for tax time isn't even during tax time. It's way before that. We do benchmarks in our mastermind, right? Get people to know where are they sitting at when it comes to revenue, because one of the important things is you cannot make decisions about your business and your tax situation if you don't know your numbers. I mean, I get on calls and I have reminders to clients that say, hey, make sure you have an updated number of what you're making as a W-2 and what your rentals are making this year so we can chat. If you don't know where that income number is throughout the year, it's going to make planning extremely hard, because if you don't know your own numbers, you're not going to be able to plan around or architect your income like we talk about.
That's a very valid point. I got to give a shout out to my man, Kanye Harris. How are you, buddy? I miss you, my man. This guy single-handedly made my $10 million ground transportation business. Love you and hope you are doing well. We need to reconnect. So in regards to that preparation, you talk about P&L, you talk about your financials. I mean, you're in our mastermind, I'm very stringent about having P&Ls done every single month by the 10th, right? So what are some things outside of like the standard P&L should they be looking at? I think most people probably don't know how to read or calculate a balance sheet. Is that important at this point? What about formulating their receipts, or do they need to have their material participation ready before tax time?
Yeah, we'll talk about the balance sheet. The balance sheet is one of the most, in my opinion, every single business should have a balance sheet, of course. In some businesses, they're way more important than others. To me, a balance sheet, especially for real estate investors, a lot of that's going to depend on your journey, your investing. So we talk about this a lot. What are you taking on debt? Right. So somebody my age or early,
use me and you,
30s,
double your age.
Exactly.
Secret. Right. Exactly double his age. And our strategies are completely different, right?
So my balance sheet is if let's say I have a $2 million net worth, I might have $4 million in assets and I might have $2 million in liabilities to come up with $2 million of net worth, of net equity. You might have, let's just say you had the same net worth, but you might have a lot more assets compared to liabilities, even though it's the same net worth, because somebody who's getting closer to retirement age, just by nature. Now you could be, I just talked to somebody this morning that is flipping that switch for family reasons and family purposes. But the more that you get on towards retirement age, the less of your balance sheet should be made up of liabilities and loans, and the more you should have in assets and net equity.
And is there any rule of thumb that you use for your clients?
I don't have a steadfast rule of thumb. I have a kind of generalization. If you're in if you're in asset accumulation stages where you're trying to, using your W-2, using your business income to buy properties, we actually talked about this with John Hodge from the accelerator program as well. Is there's almost like a dead zone. And we talk about the dead zone being between 30 and 60% of equity in a property. There's really nobody that's winning at that point. The bank doesn't have the upper hand. You don't have the upper hand. That 30 to 60% of net equity on a balance sheet for a particular property seems to be this area where a lot of decisions need to be made. Right? If you have 60% equity in a property, the first thing that I'm looking at is, what is your return on equity? Right? Because let's say I have $500,000 parked into a property that's only generating me 30 grand net income per year. My return on equity sucks for that property compared to I might have only $300,000 parked in that property and it's making me the same 30 grand. So that's probably a good return on my equity. All these calculations that if you don't know your numbers, you're not going to be able to make.
So let me give you a use case into something that you just said. I have 2 properties. I'm 45 years old, and I'm going to retire at 60. I make 100 grand a year W-2, so I'm not making enough to really be able to save to make my next investment off my W-2 income for probably 5 or 6 years, right? And then we're looking at a $500,000 property. So I have 2 properties that I paid $600,000 for, and both of them have $300,000 in debt. What are you advising me to do? I mean, I know what John would tell me to do.
Mm-hmm.
Hey, go cash out refi or HELOC out as much as you can on the property with the lowest interest rate available, and then pay off the highest interest rate down to 0. If you won't be able to get it to 0 because you can't borrow 100%, but you should be able to get it to probably 10 to 20%, right? Is that what you would advise somebody in that situation?
So then that brings up another conversation is what we call, at least in the financial world, they call it interest rate risk, which is just and then there's market risk and operator risk, but it's basically the risk of, hey, I have this debt here. You probably have it at a very low interest rate, right? We're probably talking like mid 4s, early, low 4s here. To then go into something, whether it's a refinance, a HELOC, you're going to be buying something else, right? And you might be buying something else at a double the interest rate or a 6 or 7%. So there's this inherent risk of doing that. And what we kind of alluded to is one of the smarter pivots or plays here is to think about the time that you're spending, right? If I'm spending, if I have 2 properties that are each $500,000 and they're cash flowing this, could I have one property that's $1 million? I'm still spending similar to the same amount of time, but it's making the same cash flow. And there's only 1 roof compared to 2 roofs, or 1 septic compared to 2 septics. But right now, I mean, I think we've talked about it too, is because of the interest rate environment, we are seeing a lot of people pivoting to co-hosting. Right. And so me personally, I don't have any business doing co-hosting just because it's not the highest and best use of my time. But I do know a lot of owners, a lot of clients of mine that have 2 or 3 properties under their belt, and they're looking to make that next purchase. But, the numbers are just not making sense right now. Their debt service is way too high. The cash flow is not there. But one of the good ways that they're able to stay in the game, get that experience, and use their tools is to pivot to co-hosting.
I can't disagree with that. I think it's the safest and lowest common denominator from really an entry level into this market, or even an expansion right now. I mean, I've got 13, really technically, probably 14 properties by the end of the week that I will be co-hosting. And I've been able to leverage that to not have to touch my rental income, right? Where it used to be that I would use my rental income to reinvest to build up my own portfolio. Now I'm using the co-hosting income to make those investments. So I can absorb a lot more losses and, make infrastructure updates in the own portfolio as well. So I think the interesting thing about what we do, Ryan, is there's no right or wrong way. There's the best way for you, right?
That's right.
And I can't emphasize this enough. There's a lot of people out there that do what I do, that do what Ryan does, and they're selling you a system, their system. And I think that's bullshit. Because there is no system in taxes. There is no system in investing. You have to educate yourself, and your path. Ryan and I are a prime example. I mean, God, I used to be the young guy. Now I'm the old guy. I'm almost 50. Ryan's almost 25. I'm 2.5 decades older than him. I am under 5 years to retirement. Ryan may or may not. He might retire at 30. I don't know. But what I can tell you is that if Ryan and I sit down over a beer and we line item out or document and show each other our strategies, they're going to be black and white, yin and yang, completely different, right? So I think that's one thing that I really want everybody to understand is, you shouldn't be looking to a course or buy a system or whatever it is. You need to look at somebody that's flexible and is trying to help you make the best decisions for your outcome for the path that you're on, right? And I know you did something last night, Ryan, that I just want to talk about real quick. You had, I think, a couple hundred people or whatever. You did a webinar last night. What was that about that you did last night?
Yeah, so that webinar was focused on getting ready for tax time. So we talked about 3 key principles of why it's important. So number one is speed. So there's a lot of people that, number one, we want to know whether or not we're going to get money back or we're going to have to owe as quick as possible. If I have to make decisions about my business, I need to know exactly what is going to be my cash inflow or outflow from the federal and state governments. With speed also comes with timing. I had 3 or 4 people this past year who had unexpected tax bills of the $30,000 or $40,000 mark because they're high. Let's say they're high W-2 or they had an awesome year in their business and they weren't properly making the estimated payments or the calculations. I've seen people have properties under contract March, April, May, and literally cannot go through the contract because they have a $30,000, $40,000 IRS bill due, and the bank's going to see that pop up on their credit, or the bank's going to see that pop up on their statements, right? You have to know, especially if you're in buying mode this early spring, you need to know what your tax, what you're going to end up owing or what you're going to end up getting back as quick as possible. And then lastly, refinances, lenders. People, your banks are going to want to see your tax returns. I mean, I had the bank that I'm working with now, they reached out, they want to see my 2022 tax return. I'm like, the year just ended 3 days ago, but they want to see it immediately. So speed is very important. And we kind of talked about what are some of the things that you can do to make sure all these ducks are in a row. What are the importance of it? We had an awesome turnout. I had a blast. It went a little bit too long, but what are you going to do?
So Ryan, you said that a bank is asking for your 2022 tax return like today?
Yeah. Yep.
Isn't the earliest date you can file in February?
Late January, yeah.
Late January. That is insane to me. So what is your response to that?
Just an email saying that the IRS portal isn't going to be open until late January, so there's no possible way I could have a filed tax return on time.
Did they reply?
Not yet. No.
That is very interesting to me. So it's kind of, I mean, I literally was just attaching my audited P&L to an email because I'm under contract right now trying to buy a property. And I've had to do 2020, 2021 tax returns, and then they wanted an audited P&L, for 2022 because I probably won't file till February or March and have the February 20th closing date. But I've never heard of somebody requesting that, and I think that's something that becomes really important for people to understand as banks tighten up. And this is where John the Bank Whisperer Hodge becomes really, really important. There's different levels of what banks are going to be looking for documentation. And John breaks it down to like a level 1, a level 2, a level 3. And actually, this is his week of training in the accelerator program. So we discussed this on Friday, right? It's really interesting. And I think that coaching call is going to be very interesting. I think a lot of people don't understand that it's more than just your tax return. It's more than 2 years. A lot of banks are looking for 3 years tax returns. They're looking for cash flow statements to go, especially if you're self-employed. They want audited financials versus just sending them a QuickBooks P&L. There's a lot of time and expense that goes with that stuff. So that's one of the things that I think is really important in your planning of what your asset allocation is going to be like. What are you looking to purchase? What types of properties? Because it gets even more complex if you're getting into multifamily. you're going through a kind of a unique development project right now, right? And that is so different. If somebody tried to go through the qualification for that and they were only used to buying single family homes and they weren't prepared, they're most likely not going to qualify, right? So I think that preparation, just like Ryan talks about, having your documents ready now. And if you've had a great year in 2022, I just did almost 2.5 times what I did in 2021. I'm going to file as quickly as we can. Probably, like I said, sometime in February, maybe early March, maybe earlier. I mean, I'm ready. The question is I just got to wait for my cost segregations to get done. I don't want to have to go back and do a change of accounting, after filing. So once those cost segs are done, then I'm ready to file. But the strategy should be is if you make more money in 2022 and you need that leverage, you probably need to think about filing sooner rather than later. Would you agree with that?
Yeah, and that's right. Like you have to know what season you're in, right? If you're going to get ready to make a purchase or do a refinance, you just have to know what sort of documents that they're going to expect from you. Yeah, I'm doing commercial loans, so the banks have probably a little bit more stringent requirement for a commercial loan, especially for a person that's self-employed. It's a lot harder for them to verify their income. What's actually funny is on the other commercial loan that I did, the bank person, the staff reached out and said, can you have your CPA sign off on this? Funny, because that's just
you're like, sure, I'll get that right over, right?
Yeah, let me go talk to him real quick. I'll get that to you. I just thought it funny. I just kindly replied, just said like my occupation on my tax return says CPA. Yeah. So anyway,
that's hilarious. Those of you that are still watching, if you have any questions, just drop them into the comments. We've just got a couple of minutes left. We can probably get 1 or 2 more questions in for Ryan. If you guys don't have any questions, we will wrap up and see you next Tuesday at the exact same time. Make sure you follow Ryan on Instagram, and all of his channels is Learn Like a CPA. You can follow me on Instagram at BillFaith73. Doesn't look like we have any more questions, Ryan. So we will see everybody next Tuesday. Thanks for joining us on Tax Tuesdays, everybody.
Bye, everybody.